All right, we are here with the mid-year update. I am here with Christina Beitler and Chris Jacob with Housing Report. So we're going to get started in just a second, but before we do, if you're watching this on YouTube or Facebook or anything, you have any questions for us, type them in the comment section, and like and subscribe for future content, if you will. Chris and I do this pretty regularly, and I would try to put out about a video every 2 weeks. So with that said, thank you guys for coming. And yeah, so let's see here. Chris, you want to start us off? Tell us what you got going on and what you're seeing in the market.
Yeah, so you've got a slide here we'll share in a second, but what we've got is an interesting situation of the market shifting back to a more normal business cycle, something we've become more accustomed to the last 10 years. And we're starting to see some a lot of the craziness leave the market. We're back to, hey, you can show a home more than one time. We've got slight decrease in incoming pendings, but nothing to be kind of worried about. We've got good solid numbers going in. I think we'll still have a top 5 year, I think, when it's all said and done, when the numbers land. Yep. But there's a lot of interesting moving components in the marketplace right now that are impacting us. And we've done these a couple times now, every few weeks. And as you see, we brought in a lender who helped us do our Q1 update last year, or last quarter. And here we go. You want me to spit some numbers out for everybody, or should we
do it?
Sure.
All right, here we go.
Do you want me to share my screen?
Yeah, share your screen. We're gonna do the first slide.
Okay. Let's see.
Let you get it pulled up. And these numbers are as of 8 a.m. this morning. So as agents, we know we're very slow to report sold data and other data. So sometimes there's some lagging information. But Q2 listings were up about 17% to the year prior Q2. The average value is up 22% for new listings. Pending listings are down about 19%, 18 to 19%. But because we're still in sub 6 markets and still in a seller's market, the average list price for a pending for Q2 was $684, which was 120%. Next one down, Ryan, or next box down, 120% increase in average list price for our pendings for Q2.
It's crazy.
Yeah, and if we go look at our solds, which is a little more, sorry, I literally threw this together. So if we look at Q2, down one more box set there, Ryan. The count for Q2, we're down about 13% solds. Average list price was $667. The average close price was $694, so they closed at a 5% premium over list price, and the close price was a 15% quarter over quarter increase to last year. So pretty healthy numbers still. That's just one quarter. As you look at last quarter, it was a 19.6% increase, and I suspect we're going to end this year. And I went on record about a month ago. I think 2022 we're going to end up between 8.5% and 10% year-over-year value increase as we return into this more normal marketplace.
And that's crazy.
What do you think about, like, people that are saying you're seeing, properties go under list price reduction. I did some preliminary research, and I noticed that in the month, I think it was June, that there were 8.8% of all everything that was listed in MLS had a price reduction. So do you think that in the short term we're going to see a slight drop in value and then go up, or is it just going to remain flat?
I think, Ryan, as we enter in Q3 and Q4 year over year, the values tend to flounder. Our values are we always set our peak value for the year in the middle of Q2. Now, does it hit early May? Does it hit late June? Q2 is always where our values kind of peak. So I think some of those price reductions would have happened regardless of where the marketplace was, just through the normal cycle. And I think some of our opportunity sellers who were like, well, man, if I get 30% of our marketplace, I'll sell. We're seeing those guys kind of fall in the market. Withdrawals and expireds are up through the roof compared to year over year. I really think what we've got going on right now is it's a moving and shaking day in golf. It's just, hey, where we're going to kind of land. The market's trying to figure out where its feeding is. What was
Yeah.
interesting was I've been talking about pendings are the most important thing we have. And we had been on a 6-week slide on demand.
Mhm.
And what's interesting, and you can speak to this, is interest rates over the last 10 days have softened a little bit. It's like the market has found where interest rates should land. And I think where those sort of, yeah.
And that's the crazy thing is, you can't listen to everything you see on the media because it's lagged. And the challenge we're facing is rates change so quickly, so fastly. So we saw softening, we saw lower, but when the jobs report came out on Friday, we lost all of that softening and we went right back up.
Oh, really?
So where are we right now?
So from Freddie Mac's perspective, APR wise, we were pricing about 5.85 as of Friday. Now, of course, that's not today's numbers, which the marketplace is a little bit better because we're coming off that initial shock, but we lost so much on Friday that we, nullified any gains we had throughout the week.
Wow. I hadn't seen those in my numbers yet because that would show up Wednesday for me.
People don't know because they're not in the real time unless they're under contract. So they're not pinging their lender going, hey, where are rates today? They're not doing that every day.
Right.
And that's how quickly things shift.
Yeah. From a loan perspective, where do you think, what's the prediction for, the next few months of where rates are going to go?
Well, the biggest thing is reaction to what the Fed is doing. So, the Fed is increasing the Fed funds rate, which that doesn't directly correlate to our rates, but it's more of a shock factor. When people hear that, they panic, which it's coming in July. They're going to do another 75 basis point increase because the job numbers are so strong. They're not worried about negative GDP, which we've had another negative quarter of GDP, which is starting to signal we're in a recession. Their primary goal is we've got to temper those 40+ year high inflation number. So they've got to cool off this demand. And that's what their primary goal is. They want to shock the system to where we flatline and stabilize a little bit. So it's hard to say. Nobody has that crystal ball, but I don't think we've hit our peak.
Yeah. Okay. Gotcha. So we could see interest rates 6.25, 6.5, maybe. Yeah. And then you think there'll be some tapering off as inflation starts to subside.
Absolutely. I think, as inflation and recession, as they announce recession and they fully accepted the Fed and, the people who say this is a real thing, that anytime there's a recession, rates temper back down because they have to, because then they want to re-stimulate the economy. It's just, when does that happen? And that's the part that's really unknown. And it's kind of like you and I talked about people, and this is the mind shift, because that's what we talked about, right? We talked about a mind shift. Is, what's the biggest generation that's buying right now? Millennials. And they've never seen interest rates over 5% ever.
Right. Yeah.
So they're balking. Like you give them a quote and they're like, oh, that's too high. And you're like, go talk to your parents real quick.
Yeah. I think my first house was 7.5, if I'm not mistaken.
Absolutely. And so it's a mind shift. And so they're just like, okay, well, I won't buy. I'll wait till the rates come down. And so that's what they're doing. They're holding out.
Gotcha. Okay.
That's a slippery slope. These people who wait for rates to drop, because let's just say they want rates to drop a point, but values go up 15%. That home is a net 5% more expensive tomorrow than it is today, which is
And I think, I don't know if you guys have heard this. I've just gone around the real estate community, the saying, date the rate, marry the home. I don't know. Have y'all heard that yet?
Oh yeah.
Yeah. Absolutely. Yeah. Which makes a lot of sense because, if they do go down, which they probably will, then, you're still going to have that increase in price if you're living in Austin, most likely. So it makes sense for agents and lenders to talk about that. So Christina, tell me about from last I checked was about a week ago that the ARM rates aren't really doing that much to save a lot of money. Is that right?
Right. The spread between a fixed and an ARM is not far enough to really make them impactful. But again, lenders, so
Yeah.
you know, your Fannie Mae, the people who back these rates, they don't see the appeal in the risk that's involved. So rates are priced on risk and sellability on the back end, and ARM's still, again, a mentality thing. People hear the word ARM and they're like, I'll refinance my fixed rate down the line then instead of getting into an ARM product.
Gotcha.
So it's again, we're seeing a big mind shift and a big cultural shift of this is a new norm. It's very unlikely we go back to those sub 3 rates. I think that was a blimp in history.
Yeah.
And I don't see us coming back.
Yeah, right. And what about jumbo loans? Last time I checked, it's been a while, but they were significantly lower than 30-year fixed. What are they sitting at right now?
They definitely price lower than a fixed. You're going to be in the low 5s on a jumbo. And that's just because those are private lenders. So they know most of the market is jumbo now. Because what's our average list price or average sales price?
Yeah. The average sales price in Q2 was $694.
Right. So you do a minimum down payment, 5 to 10%, you're right at the conforming loan limit. So your majority of your market's jumbo. So they know there's that demand and appeal. And so they price more competitively because people need them. They have that product.
That's right. Yeah. And they're putting more down on a jumbo loan, right?
Less risk.
Yeah, less risk. Okay, gotcha. So Chris, you want to take a look at the other slide you sent me?
Yeah. Let's look at the real time. I think this is the story that really is the important one here.
Yeah.
So if you could scroll, so it's kind of centered in the screen for everybody, or zoom in a little. This is the real time data of just what we're kind of looking at. And what was interesting is when we go look at the last day of Q2 actives, we had 275% more homes on the market price with a very similar list price. So what's cool here is consumers actually have a chance at going and finding a home on the market today and having a chance to look at it. And pricing for average list is not that far off of where we were last year.
Right. So we're seeing like a flat here almost. I mean, a slight increase, but yeah.
Absolutely. And if you look at how Q3 and Q4 for real-time actives did, we actually saw the average list price drop as the year finished out. And that's that floundering that occurs every year. So I think people need to know that we're so used to just values always going up. I really think the second half of Q3 and Q4, there's going to be great opportunities for people who've been sitting on the sidelines to reach in and get a home and actually look at it for more than 5 minutes.
Yeah.
Before they have to buy it.
Well, right. I know someone had told me the other day, like, it's so nice to go out and show, 7 houses,
Yeah.
I mean, we're used to like, all right, pick up the phone, let's, meet out here, show that one house, and then hopefully we can get in it fast enough before it sells.
Exactly. Or write the contract in the car on your computer.
Yeah. Right. Yeah. And I think what agents have to do for their part on the buying side is set realistic goals. Like, let them know, agents need to be talking to everyone that was interested in the last year and say, okay, for those of you who can afford the increase in rate, this is your opportunity to really get something at a fair price without the stress that you've had the last 2 to 3 years, and really secure this home that you want for the rest of your life, or for the rest of your life, but for the foreseeable future, right? And then on the listing side, I had an agent, come to me like they want to list their home 100,000 more than comps. I mean, you're going to have to pick your battles. I'd rather be the second listing agent than than the first one, right?
Exactly.
And then also, we talked about this in our weekly huddles, is like, if you have a listing, you're going to have to do more work and more preparation, more setting expectations. Days on market. I just looked on Friday, they were at like 20.1, right? We actually have what is that in terms of months of inventory now?
So months of inventory when we ended. I knew you were going to ask this, Ryan. Give me a second.
2.
Oh, I think it's
3.
a little. Well, no, the official months of inventory for the last day of the quarter was 2.81 months of inventory.
Yeah.
When was the last time we were in that position?
2.81 months. That's another slide. So if
2019 maybe.
Yeah, our months of inventory was about this level. Last time we were here is during the COVID shutdown in 2020, which is when the world stopped and
Yeah.
nobody was doing anything in that 3-week period. We were at that level. And then before that was late Q3, Q4. We were at this level of inventory in 2019.
Yeah.
Wow.
So I'm a firm believer that we are working our way back towards a more normal market. And I'm hoping the market settles in this 2 to 4 month inventory cycle.
Yep.
And we get back to going to business like we have for the last decade.
Yeah, so agents, what they need to do here is be able to prep their clients, give them more information than they have before. Let them know, look, here's what we're doing with pricing, okay? Because things are moving really fast. Interest rates are going up, going down. That you know, this is the price that we think that we need, and then you're going to have to be able to check on the price adjustments every maybe 2 weeks, maybe 3, right? Used to be when we were in the single digits that you didn't have to worry about that, right? So, anyway, that's kind of where we're at with that. I think it's really important for agents to be able to have a time cycle where they're working with their clients and letting them know, okay, after 2 weekends in the market, we're going to check in and we're going to decide what we do. We need to meet, evaluate the data, and the data is the showings, how many offers you got, the feedback, a pulse check on the market since we first listed the home, that type of thing. That's going to set agents up for success, in my opinion.
Absolutely. Absolutely.
Oh, yeah.
I've already started coaching I got a listing lead that I was working this weekend. And I told the guys like, hey, day 21, that's gonna be price reduction talk.
Yeah.
We could test some pricing here, but at day 21 leading in, we're gonna be talking, we need to reduce this if we make it that far.
Yeah.
And it's kind of weird because you never had these conversations like, hey, we're just gonna price it right. As long as we get 30 people through the door, we'll have 6 offers, deal's done.
Yeah.
And it's kind of weird because in Central Austin, I was like, I'm gonna prepare him for the 21-day talk that I
Yeah.
was taught 15 years ago.
We've just so been used to not normal,
Yeah.
for the last couple years. And it's just, again, it's a mind shift of coaching the seller's market, coaching the buyer's market of, hey, this is how it is now, the way it was a month ago, or even prior to May.
Yeah.
It's not that way anymore. And I think
Right.
it's the hardest job we have.
Yeah, but you know what? It also makes our job more valuable as listing agents, right?
True.
That someone can argue that, in the height of the market, I wouldn't believe this, but that you almost don't need a listing agent, right? You could argue that, but the reality would be you do. It's just not as valuable as it is right now.
Correct.
That's right.
Agreed.
Yeah.
That's right.
So we have to earn that value. We have to do the things that we used to do, because the hardest part about last year and year before was getting the listing. Okay. Now it's about actually selling, setting expectations, making sure your client's fully informed of the things that are changing in the market that are going to impact their goals. Yeah.
I actually had my personal transaction I just closed on Wednesday last week. Ryan, you'll appreciate this. I thought it was a little overpriced. We sat our offer on the table. They came back and countered 1,000 below list, and I said, you know what? We'll wait for the first price reduction because I don't think it's going to sell at this price point. But our offer sits until you either have a price reduction or I buy something different.
Yeah.
It was about 13 hours later, I got a phone call that they accepted our offer.
Yeah.
That they had a long talk about, they were day 17 on the market. I was like, oh, day 17 on the market. You're due a price reduction.
Yeah.
Statistically.
Right. Yeah.
And they, we got to get good at buyer's agents knowing to kind of keep the emotions out of the transactions.
Yeah.
If the numbers don't support it and your clients aren't, oh my God, this is the house, work on those negotiation skills of just be patient.
Yeah.
The market's having new listings come on the market at greater speeds than we've ever had in the last 4 years, that the next better house might be cheaper tomorrow.
Yeah.
If you're just willing to wait and wait it out, if you could wait the interest rate game out.
Well,
Yeah.
and that's the thing, is that's where it's just more important than ever to have an agent on both sides. As a lender, so many people went in, without any representation. They went in without any guidance because they could. They were just throwing it at the wall and see if it would stick, right?
Yeah.
And if you had any coaching or just pulled up a contract online, you had people doing it. And now today, it's super important to have those relationships and that representation, because it's a true negotiation game. We are going back to the basics of what makes our industry important, and, you know, having those people there to guide you in the best way so you're not getting a bad deal.
Yeah, and I don't know anyone that's ever won by waiting on the Austin market.
No.
You know, I mean, you might maybe wait seasonally, but if you're looking for your dream home, that's not gonna always work out for you either. You know, if you're looking for investment property, sure, seasonally, you know, second quarter, some good deals to be had. But you know, I've got one client that, like, I stopped selling real estate last year and only sold a couple houses, and but I have one client that's been looking forever and ever and ever, and they already have a home, but, like, you know, they're looking in luxury from 2 to 3.5 million, and every, you know, they just can't find the right home. They're super picky. They don't want to spend the money for it. It's not gotten any cheaper for them. You know,
No.
it's not. And there's several homes that I know that they're kicking themselves like, I wish I would have paid that price, which at the time seemed to be way higher than it should be. Okay. But not anymore.
Yeah.
Yeah.
Well, you know, this, and the crazy thing is the longer you wait for interest rates to change too, you're losing that equity position. So
Yeah.
that's the mentality, you know, where a good lender will say, you know, team up with you guys and say, hey, don't wait. I tell people, get in the market if you can. If you can afford the payment and you're comfortable here, you're not stretched, you're comfortable, let's get you in. Let's get you in the market, because, you know, even if you're at 6%, or, you know, let's just throw 6.5 out there.
Yeah.
On average, Austin has earned historically, not the last couple of years, but historically, we're earning 5 and 6% appreciation.
Yeah.
And you just use that 5 or 6 appreciation in 5 years. That's 150,000, you know, on what did I have? I wrote up a workup on that, you know, on a $600,000 home, that's 150,000 in 5 years. That's quicker than the stock market could ever give you.
So for my investors, we use 3.5%
Appreciation.
For all our modeling, just like, hey, where's this going to go? And the assumption is in Austin that renters are going to be harder on a home.
Yeah.
So we're not going to realize those gains. We're not going to maintain it and keep it in style as much. But for my long-term investors, where we do our buy and hold things, our modeling is all built on 3.5% annual appreciation for these investors. And most of these investors are looking at these rates going, they suck today.
Yeah.
But rents are going to catch up in 2 or 3 years. And if I could buy at a net zero today, I'm going to win the long game.
Absolutely.
I'm going to win with inflation. I'm going to win with appreciation.
Yep. And I was giving that coaching to my client, I mean, to my agents with their clients when people were writing offers 8 to 10 to 15% above, right? Okay, yeah, you might be overpaying for in the short term, right? But if you look at historically the last 2-3 years, like, that's not even 6 months worth of appreciation. Right.
That's right.
So now you have the flip side of that, where you don't have you're probably not going to have 15, you know, probably not going to have 20-25% appreciation, but you're paying more for the mortgage. Well, you're still going to realize, you know, you're going to realize that within a year, if our projections are right, which I'm right with you. I think it's going to be 10% over the next 12 months.
And right, it's some of the things people also tend to forget. If the mortgage, I believe it's 750,000. If the mortgage amount is less than 750,000 as your primary residence, you can write 100% of that interest off your taxes.
That is correct. As of now, that's correct.
As of now, and the rules change every year, every tax cycle. So it's not like, okay, so you're going to write it off. There are some tax benefits that are, you know, you don't the soft benefits that you don't realize in your monthly cash flow. But Ryan, I do have a serious question.
Yeah.
I know you run all your listings through your iBuyer portal to try to get your iBuyer bids up as high as possible. What have you guys seen in this last quarter?
We haven't been doing that. We don't run all of them through there.
Okay, I knew you ran a good portion.
And we do that. I mean, you know, the investors they're being a lot more skittish about doing that. So most of the time, they don't give us the right offer for it. Okay.
Okay.
It's every now and then, less than 10% of the time. It's a tool that we use for sellers that, you know, if they're thinking about doing it and they don't want to leave money on the table, they can do that.
Yep.
But the reality is right now, most of them are not offering what you could get on the market.
Gotcha. I was just kind of curious what that shift had been over this last quarter.
Yeah, and I'm curious for you because I think when we talked in like March, you had made a prediction about taxes being collected. What was so tell us what that was.
Okay, it's going to be October before we know. So just,
Yep.
you know, as the mill rates get set in September. So
Yep.
here's my prediction, guys. If we go look at back, and I'm using the year that Travis County did not reassess for my theory.
Yeah.
So the only people who paid more taxes in that year was at 19 to 20 when we did not reassess. The only people who paid more taxes were those with homesteads because of the homestead cap went up. Every investor's taxes went down. So this year, with this massive bump in values at the CAD, it was 56% Travis County before the equalization process. The homesteads are going to go up 10% in appraised value, but the free market's going to go up to whatever market value is, except for we've got this beautiful 3.5% budget cap at our government levels.
Yep.
So I firmly believe that, and I'm going to use City of Austin because I live in the City of Austin, as do you, Ryan. Their budget can't go up that much. There is new construction. They go realize 100% of those gains, but the majority is just old existing housing stock. So my wife and I have $100 bet, which we normally bet $1 as not to get emotions involved and just as the principal bet, that we're going to pay less property taxes in 2022 than I did in 2021. Okay. And that's going to be the homestead cap raising our value at 10%.
Yep.
But then that budgetary cap at 3.5%, I believe, is going to push more of the tax burden over to raw land, investors, commercial. And it's going to provide homesteaded homeowners a little bit of tax relief.
Okay. But what about the investor tax relief? Didn't you think?
Oh, the investor. Well, I think the investors are only going to go up 10 or 15%. I just whatever.
Because of budget caps.
Because of budget caps. Budget caps are going to prove to be, you know, Governor Abbott, and I think it was a 2019 legislative session, put this 3.5% cap in place. It used to be 8%. Mm-hmm. So they reduced it from the 8 to 3.5. And it was like, wow, I don't think they had the foresight. I'm not going to give them that much credit.
Yeah.
But it's just kind of nice that this was taking before the crazy valuations.
Yeah.
That they weren't kind of reactively doing it after the fact, but there was protections in place. And I believe, you know, those protections are going to really limit what investors' tax bills are. Most of my investors, I have not sold one for taxes at all. And I deal with a lot of people. People are not calling me up and going, sell, sell, sell. When we have the intellectual conversation of, hey, here are the caps, here are the mechanism, I really think it's be 10 to 15%. Every investor I've talked to is just like, I can deal with that.
Yeah.
You know, 10% increase is a lot better than the values went up 56%, but nobody on the news in Q1 would tell you, well, there's caps in place.
Yeah.
We don't think it's going to be that bad. It was, here's a story that bleeds is a story that leads.
Right.
Ratings are important.
Ratings are very important. And I've kind of been quiet sitting over here going, I don't think it's going to be that bad. I don't think it's going to be that bad. But
that's going to be interesting to watch. And I'm sure we'll do this back again in October.
Yes.
Anything else you want to add to our conversation today, Christina or Chris?
No, I just think, you know, we have the hard push of, you know, well, I'm praying that things stabilize. We just need some stability, not these craziness, which, you know, rules tell us that mind shift takes about 90 days. You know, this all started happening in May. So we still maybe have another 30 days for everybody to conceptualize this.
Yep.
I think property taxes are also paying a little bit into why buyers aren't purchasing because they're really nervous about those monthly property tax bills.
Yeah.
So maybe September, October, when those bills get out and rates hopefully stabilize with the Fed continuing to do what they do, I hope we see another push, which I think it's coming.
Yep.
And
I certainly think next year will be in March, we'll see more of a normalcy, less fear, you know.
Yeah.
I think the key, Ryan, and we've talked about this, and I say this on the housing report all the time, is the demand needs to figure itself out, whatever it's going to be. You know, we're in this kind of like, oh my God, we have a free fall, then a small spike. Yeah, I think rates are going to play an important component in that. And I think the buyer's psychology of realizing owning real estate in Austin is far better than ever renting, because every renter makes all my investors a ton of money.
Yeah.
Well, and rents are going up, what, 14 to 28%?
Yeah.
I'm
Yeah.
pushing about 25 this year on almost all
Yeah.
mine.
Yeah.
And it's
Yeah.
one of those where I hate making those calls. So I'm doing them personally this year, making phone calls versus emails, and just letting them know it's the economics of ownership.
Yeah.
And I remind all of them going, you probably should have bought 2 or 3 years ago.
Yeah.
when it was a lot cheaper. But yeah, it's I think we're going to see a bunch of.
Yeah, what's interesting with the rents is like, you know, I have a client, I have tenants that are like, I'm not going to pay, you know, $200 more. And actually, we don't keep up with the market. We don't.
Right.
You know, I raise the rents to something reasonable, but not keeping up with the market, because I don't want to do that to them if they're good tenants. And they'll say, no, I'm not doing that. And then 2 days later, yep, I'm doing it, because they look at what's on the market. You know.
Exactly. I've Ryan, what I've started doing for these tenants is I do a market analysis of what's available. So they know what the alternative is. And then I go and say, look, if you guys move out, it's going to cost me a month of vacancy. And I've been taking the market rates minus 1 month of vacancy and using that as my benchmark.
Exactly. Yep.
And just going, here you go. I don't want the vacancy. Y'all don't want to move. It's a win-win for everybody. And we pray that those rate increases cover the tax bill.
Right. Yep. Well, guys, thanks so much. Chris, you can find you on Housing Report on Facebook. Is that right?
Yep. Yes, sir.
Christina, where can people find you?
Well, I'm currently over here at Lone People, so I'm with the elite team. So you can always find me at ChristinaBeitler.com.
Awesome. Well, guys, thank you so much for being on today.
Absolutely. Thank you, Ryan.
Y'all take care.